Welcome to the Deep Dive. We're here to help you cut through the noise, taking complex financial data and giving you the key insights. Today, we're digging into the market performance and trading stats up to the end of August 2025.
That's the plan. We're not just listing numbers. We want to really synthesize the key movements, index shifts, sector performance.
And critically, the investor flows.
Exactly. Especially comparing that sort of domestic enthusiasm we're seeing against what's happening with external money.
Right. And looking at the data, the big headline right away is that August was, well, pretty explosive, wasn't it? The whole market just surged.
It really did. You see that immediately if you just look at the main indices.
Yeah, let's start there. The ASPI, the All-Share Price Index, it kicked off August 2025 at, what was it, 19,642.
Just about, yeah.
And it closed the month near 21,000. That's a jump of 6.90%. That feels pretty significant for just 1 month.
Oh, absolutely. And it wasn't just, a few specific stocks carrying the weight. The S&P SL20 index, that's your top tier, most liquid companies, it also had a really healthy gain.
How much did that one move?
It went up 5.46% for the month, moved from about 5,762 up to over 6,076.
Okay, so broad strength then. When both are moving like that, it suggests pretty widespread confidence.
Definitely.
Now, that August jump sounds big, but how does it stack up against the whole year? Did it make a real dent in the year-to-date performance?
It really did. That August rally basically propelled the whole year's performance. If you look at the ASPI from January 1st through to the end of August, it's now up 9.14% for the year.
Okay, respectable.
And the S&P SL20, also solid, up 7.33% year-to-date. So yeah, August was definitely the engine that dragged the year firmly into positive territory.
And that momentum must have translated into overall market value, too.
Absolutely. The total market capitalization, the value of all listed companies combined, reached about 7.425 trillion rupees by the end of August.
Yeah. And how much was that up compared to July?
That's a 7.68% increase just over the previous month. So it confirms this wasn't just a little upward drift. It was a pretty substantial injection of, well, optimism and perceived growth.
Okay, so for people trying to gauge if the market's getting, overheated or expensive, we need to look at valuations, the PE ratio.
Right, the price to earnings ratio. It climbed. Went from 9.14 in July up to 9.81 by the end of August.
What does that actually tell us? A PE of nearly 10?
Well, it essentially means investors were willing to pay almost 10 rupees for every 1 rupee of annual earnings a company makes. That rise tells you two key things.
Okay.
1, prices rose faster than earnings during August. And 2, investors are feeling pretty bullish right now. They're actively pricing in expectations of, decent future growth.
And it wasn't just the PE, was it? The price to book value ratio, the PBV, that moved too.
It did, yeah. Also up from 1.31 to 1.41. When you see both of those key valuation ratios climbing together, it really underscores that surge in confidence.
Makes sense. But usually when prices go up fast, the dividend yield comes down, right?
Exactly. That's the classic dynamic. The dividend yield dips slightly from 2.52% down to 2.30%.
Why is that?
Because the yield is just the annual dividend divided by the share price. So if the price shoots up because everyone's chasing capital gains, that fixed dividend amount becomes a smaller percentage of the higher price. The market's basically saying growth potential is more attractive right now than immediate income.
Got it. So huge optimism, rising valuations. Did this translate into a lot of actual buying and selling? What did the trading activity look like?
Oh, the activity was massive, really staggering volumes. The total equity turnover for just August was almost 132 billion rupees.
132 billion.
In 1 month.
Yep, and that involved nearly 4.8 billion shares changing hands. It just confirms extremely high liquidity and, well, pretty aggressive participation in the market.
That's huge equity turnover. What about the other side of things, like corporate debt? Was there much action there?
It's fascinating. The focus was almost entirely on equities, on chasing that growth and maybe volatility. Corporate debt trading was, well, almost non-existent.
Yeah, just 7 trades in the entire month for corporate debt.
Okay.
Total turnover was only about 580 million rupees. It really highlights that right now, the market's appetite is firmly focused on risk and growth, not so much on stable fixed income.
Okay, that paints a clear picture of where the action was. Now, let's get to maybe the most interesting contrast in the data you shared. We've got this massive 132 billion rupee turnover. But who was actually doing the trading?
This is key. If you break down that turnover,
Domestic versus foreign.
it's not even close. The rally was fundamentally driven from within. Domestic investors account for over 125 billion rupees of that turnover.
Wow, so almost all of it.
Pretty much. Foreign turnover was only about 6.6 billion rupees in comparison. All that momentum, the optimism driving up the PE ratio, it really points back to highly energized local capital.
Right, here's where it gets tricky then. We know domestic players are piling in, driving the market up. But let's zoom in on that much smaller foreign slice. What were they actually doing in August?
They were selling consistently.
Selling, even as the market was rallying hard.
That's right. Foreign investors bought shares worth about 4.36 billion rupees during August. But their sales were way higher, almost 9 billion rupees.
Wait, hang on. They sold more than double what they bought.
Correct. So the net result for foreign investors in August was a pretty substantial outflow. They took out net about 4.58 billion rupees from the market.
Okay, that is a stark contrast. While the domestic market was booming, foreign money was actually leaving.
Precisely. A huge divergence in behavior.
And can we see who among the foreign investors was doing the selling? Was it individuals or the big institutions?
The data breaks it down. It was mainly the institutions. Foreign companies were the big sellers, responsible for a net outflow of around 4.7 billion rupees themselves.
So the institutional money was heading out.
Primarily, yes. Foreign individuals also sold a bit more than they bought, but their net outflow was much smaller, only about 133 million rupees. It really signals that the larger, perhaps more globally focused institutional capital was making a calculated decision to reduce exposure here, even while the local market was on fire.
And is this just an August thing? Or is it part of a bigger picture this year?
Unfortunately, it seems to be a trend. If you zoom out and look at the whole year, from January 1st to August 31st, the total net foreign outflow is huge. It stands at 22.28 billion rupees.
22 billion out. Wow.
Yeah. So August wasn't a blip. It's part of a sustained, heavy withdrawal of external capital that's been happening pretty much all year, even as the domestic indices have been climbing.
That really sets up the core tension here, doesn't it? You've got intense domestic confidence pushing valuations up, while at the same time, international investors are consistently taking their money elsewhere.
It raises some fundamental questions, Is this rally built purely on local liquidity chasing returns, or is there something deeper supporting it that maybe the foreign investors are missing, or vice versa?
We definitely need to come back to that sustainability question. But first, let's see where all that domestic money was flowing. Which sectors were benefiting most from this internal rally?
Okay, yeah. Let's ground ourselves first with the biggest sectors by weight, the anchors, if you like.
Right.
Food, beverage, and tobacco is still the largest, easily. Over 1.7 trillion rupees in market cap. Then you've got capital goods at number 2, about 1.2 trillion. And banks are third, just over $1 trillion. These big sectors really set the overall tone.
Got it. Those are the heavyweights. But where did the really dramatic action happen in August? Which sectors got the biggest boost from all that domestic buying?
Well, the list is definitely tilted towards growth and maybe some speculation. The absolute standout winner was the utilities sector.
Utilities, how much did that move?
It surged by an incredible 45.57% in just 1 month.
45%. That's enormous for a usually stable sector like utilities.
It really is. A move like that often points to something specific, maybe major regulatory news, policy changes, or just intense speculative interest building up. It's definitely an outlier.
Okay, what else was hot?
Diversified financials also had a huge month, up 19.20%, and consumer services did well too, up 11.52%.
So financials and services suggest bets on broader economic activity picking up. Consumption, lending.
That seems like a reasonable interpretation, yes. Domestic capital betting on a recovery in those areas.
Was everything going up, though, or were there some sectors that missed the party?
No, it wasn't universal. A couple of the smaller sectors actually went backwards. Automobiles and components dipped, down about 5.08%.
Okay.
And commercial and professional services also dropped by 4.20%. So even in a strongly rising market, there were still pockets of weakness, maybe reflecting specific industry issues or shifts in demand.
Right. Okay, excellent. So let's pull these threads together. We've got strong index gains, the ASPI up nearly 7%.
Yeah.
Valuation stretching higher, PE near 10. massive domestic trading volume,
Huge volumes.
powering some really explosive sector moves
Oh,
like utilities jumping over 45%.
that's the domestic picture.
But running completely counter to that, we have consistent, heavy selling by foreign institutions.
That's the core contradiction. Domestic momentum is firing on all cylinders, boosting indices and valuations. But it's happening alongside this sustained, significant net outflow of foreign capital, $4.6 billion out in August alone, and over $22 billion out year to date. The external view seems much more cautious, maybe even skeptical.
So here's the final thought, the question perhaps, for you to mull over based on all this data. Given this clear divergence, this strong domestic rally happening while foreign money keeps exiting, does it suggest the market's climb is relying almost purely on internal liquidity? And if so, what does that mean for the longer-term sustainability of these higher valuation multiples, like that PE of nearly 10? Are these prices really justified by fundamentals, or is it more about local capital having fewer places to go and chasing returns?
That is the crucial question, isn't it? How solid is the foundation under this rally if the international perspective is so different? It's definitely the key thing to watch as we head into the rest of the year.
Absolutely. Well, that's a fascinating picture painted by the August 2025 data. Thanks for breaking it down with us.
My pleasure.
And thank you for joining us on The Deep Dive. We'll catch you next time.